Hi everybody, this is Alessio Rastani and welcome to this presentation, The Absolute Beginner's Guide to Trading. I'm sure that most of you probably remember from this video on BBC. There's a ghastly picture of me right there. That's a bit better. So here's a picture of me in my trading room. This is where I do the majority of my research and my work. Let me tell you a little bit about how I started.
The way I actually started trading was many years ago. Was back in the year 2000. Now, some of you probably remember the year 2000. That was the famous .com crash, right? Well, that's when I really got started. Let me tell you that was a huge learning lesson for me. As many people remember, the .coms, the technology stocks just crashed that year. And I myself was one of those guys who basically lost a lot of money that year. The reason is that back in the year 2000, I just had no rules. I didn't have any rules as to how to trade. I was basically just like everybody else, picking stocks and trying to, making money from them. But of course, that was a major mistake which I made, and holding on to those stocks. And you're going to actually realize in this webinar exactly what I did wrong. Anyway, after that, I realized, you know what? I'm never going to make that mistake again. So I had to learn for myself how to do it properly. So I decided that the only way I was going to make sure that that never happens to me again was trying to learn from professionals, actually learning from professionals how to trade. So I was quite lucky, by the way, because some of my mentors, some of my teachers that I actually learned from were themselves some of the best traders in the world. One of my mentors is a guy who turned $14,000 into $180,000 in 5 months. I've seen what these guys do, sat next to them, and I'm going to share with you a lot of their insights, what they've taught me, and what they can actually teach you as well. And as you're going to see tonight, I'm doing very well from my own trading. And the question really is, why do we trade? Why do we do this in the first place? Well, number one, it's about being self-dependent, which is basically not having a boss. I think that's the main reason why I wanted to do this. I've never been the kind of guy who likes to, yeah, sorry, I'm just getting some feedback from somebody here saying audio's off. If the audio is off, you need to look into probably adjusting your sound. All right. I think everybody here can hear me. Okay. So, okay, good. Sound. Okay. So most of you can hear me. If your audio for any reason is off, please log off and log back in. All right. Okay. Okay. So it's about the idea that I never really liked the idea of having to work for somebody else. And maybe if you're listening to this, you know what I'm talking about. I basically, how I started was, I started in law, because originally I wanted to go into, the legal business, that kind of stuff. But I realized it was nothing more than working for somebody else every single day, having no time, for myself. It was good money, don't get me wrong, but, what's the point of having good money when you can't have the time to enjoy it? So that was one of the reasons I wanted to do this. Then, being financially independent, it's about the fact that you don't always have to rely on a job for an income. So if for any reason something happens to you, to your income, you always have a different way to make an income. So that's, I think, the main reason. And, who likes the idea of every time waking up in the morning and commuting into those, I don't know if you ever lived in London before, but it's absolutely ghastly getting into the city every morning, squashing yourself into these tubes and, these subways and trains. I never wanted to do that. I also believe that trading is to make a living, not to make a killing. A lot of people assume that trading is to make a killing in the market, or let's make $1 million in the market. That's not what it's about. And I can tell you that people who take those kind of risks don't stay in the market for very long. So it's about sustaining a good lifestyle for yourself and really doing it responsibly. Now, as you probably know, apart from my trading, I also do a lot of speaking, and that's one of the things I always enjoyed. This is me in Hong Kong last year, in London and Europe. And, a question people ask me this, and it's a question you might be asking yourself right now, like Alessio, why are you doing these webinars and for free? Why are you doing these seminars and webinars? Why don't you just trade for yourself and keep all your secrets to yourself and not share them with anybody? Why would you want to do this? And I understand why people can ask that question. Well, number one is, this is not a job for me. I come from a family of teachers. My grandmother was a teacher for 20 years before she passed away. And my uncle right now is a senior lecturer in a university in California. So to me, this is actually runs in my DNA. Secondly, I know there's a lot of people who need guidance because I myself was in that category many years ago. I know when I started many years ago, I wanted someone to help me, guide me. And I didn't want to waste a lot of time and waste a lot of money to go from here to there, you know. So the reason why I'm doing this for free for you, because I really don't want you to go and waste your money out there, you know, because there's lots of stuff on the web right now. There's a lot of stuff on the internet that is simply BS and garbage. So what I want to put out there for you today is the stuff that works, okay? And finally, I think as for why I'm sharing this with you, because the market is big enough for everyone to make money. You know, there's some people out there who believe in this scarcity mentality, which is, oh, let's just keep everything to ourselves and not share them with anybody. I don't believe that's true. Why? Well, I think, you know what, if more people can actually learn how to do it properly and lose less money, so I think that's a great thing to share with other people. And lastly, I've always believed in Albert Einstein's quote, which is, try not just to be a man or a woman of success, be a man or woman of value. And I think it's very point. You know, just don't, it's not about just helping yourself, it's helping other people as well. And I think that one thing I want to make sure you appreciate is that the current economic crisis, the current European crisis that we're facing right now, and what with Italy and Greece and everybody everywhere else, you know, a lot of hardworking and honest people right now are losing their jobs. And I can tell you this, in America, it's being reported that jobless people, you know, unemployed is about 9%. Now, let me tell you, that is absolute false. The real figure of unemployed in America is much more. It's more than 9%. It's more like 16%. Because remember, there's a lot of people who are unemployed who don't report the fact that they're unemployed. So, in fact, the way the papers are kind of portraying the economy is as though things are okay and things are going to get better. But let me tell you, the financial world is a lot worse than the way the media and the papers are portraying it to be. So, and you're going to see exactly what's going on in the next few months. I think in January, a lot of things are going to unravel. So the point I'm trying to make here is knowing how to make a separate source of income apart from having a job is really important here. Also, the thing about tonight is there's no BS involved here. Strictly no BS, just pure facts, okay? So let me just begin with asking you this question. Now type into your question box if you know the answer to this question. Do you know the odds of somebody making money from trading? Now I'm talking about the average person who starts trading the markets. Type me into your question box. Okay, so some of you apparently have been to my webinar before. Okay, I'm getting 10%. I'm getting 9%. I'm getting 93%. Okay, 100%? Okay, it's not 100%. Okay. All right, I'll tell you what. Those of you who came, yeah, it is exactly very, very little. It's about 9%. Yeah. Because, you know, the fact is that 90% of traders lose money. Why is it that 90% of traders lose money? Well, you're going to see. Because a lot of people just don't understand. Trading is not just about learning a strategy. A lot of trading is psychological. And a lot of people, unfortunately, just are not psychologically prepared to face the challenges of trading. Also, a majority of people don't even have a strategy. I mean, the people I've met in my seminars and, you know, around the world really don't have a system. And those who do don't really know how to use that system in the first place. And I think, you know, I have a friend who works in a brokerage, and he tells me that 93% of people who open an account with their brokerage lose money and, in fact, basically blow up their account within about 6 to 12 months. Well, that's exactly why brokers make money from the amateurs. So here's my promise to you, all right? First of all, I will not BS you. I will tell you exactly how it is from my experience. So I will not tell you something is real when it's not. And thirdly, I will not make some overblown, unrealistic promises. And fourthly, if you do follow what I teach you here tonight, you will not end up being amongst the 90%. Okay, first of all, let's begin with asking you whether you understand the game of probability. Because, you know, trading is all about probabilities. It is not about certainties. Let's imagine this. Let's imagine you walked into a casino in Vegas. Just out of curiosity, put your hands up if you've ever been to Vegas. Put your hands up. You've been to Vegas before? Yeah, a few people here. Okay, fantastic. Okay. All right. So if you've ever been to Vegas, let's imagine that you walk into a casino, you want to play a game like roulette, and you have to land on red to win. All right? You got to land on red. Which wheel do you got to play on? You're going to land, sorry. You want to play on wheel number 1 or wheel number 2? Which one is it? Yeah, it's wheel number 2, isn't it? Yeah, why wheel number 2? Because the odds are better, right? Well, you see, that's exactly what we're talking about, guys. You see, trading the markets is all about putting the odds in your favor. By the way, which wheel do you think that 90% of the people who lose money are playing on? Yeah, it's wheel number 1. That's correct. Yeah. That's, by the way, the reason why so many brokers... But let me put it to you this way. The reason why Wall Street makes money, okay, the reason why Wall Street and you name it, all the financial system, the city, the reason why they make money is by the ignorance of people out there who are essentially playing on wheel number 1. Here's my message. I'm not political, by the way, but I want to say this right now. If you really want to hurt Wall Street, I mean those people out there in Occupy Wall Street right now, if you want to hurt them, the way you should go about it is, I don't know how much protests can do, but the way you really got to beat Wall Street is playing their own game. You got to wise up and learn how they con people. And I'm going to show you the tricks they play on people, because human beings are irrational. That's why people end up playing on wheel number 1. My job tonight is to show you what you can do to basically go from wheel number 1 to go to wheel number 2 by adding as many reds to your wheel as you can. By the way, one thing I want to make sure you're clear, you can never add, there's always going to be some black slots involved here. What do you think these black slots mean? Well, yeah, there's always going to be risks involved, okay? So you've got to appreciate that. There's always risks involved. Exactly right, Marilyn. That's right. So, okay, let's continue. Okay. So, analyzing the markets. Number 1. First, I want you to appreciate there's 2 kinds of analysis. Number 1 is something called fundamental analysis. This is basically what most people are aware of. Earnings reports, cash flow, balance sheets, economy, etc. And then there is something we call technical analysis, okay, which is looking at the charts. Basically, anything that's non-chart related is called fundamental analysis. And those to do with charts is called technical analysis. Now, from what I'm sure you've seen from my videos that I've been sending to you, a lot of my analysis is technical analysis, charts, basically. And personally, I favor technical analysis for reasons you're going to see here tonight. So what is technical analysis? All right. Firstly, the one thing I want to make sure you appreciate is that it's not technical. All right. Charting the markets is not technical at all. Let me say to you what I think is technical. To me, putting a computer together is technical. I mean, if somebody said to me, hey, Alessio, could you put a computer together? I really wouldn't know where to start, okay? To me, civil engineering, that is technical, okay? So charting the markets, so if you're not familiar with charting the markets or technical analysis, don't worry, guys. It's not difficult. It's not rocket science. What are charts? Charts are a visual representation, okay? So charts are a visual representation of the markets. Now, what does that mean? It means that, see, I'm a firm believer. I'm a strong believer in the Dow theory. What is the Dow theory? Dow theory says that markets are revealing all the available information. Everything there is to know about the price is reflected in the markets, okay, through the price. Now, what that means in human terms means that the charts represent the sum of all the fears, all the hopes and expectations of investors and market participants. When you think about it, when you look at a chart, you're seeing what investors are thinking and expecting about earnings of a company, interest rates, product launches. All these things are priced into the markets. Just give me an example. Okay. Just have a look at this chart. Now, if you were looking at this chart, okay, which direction is this stock going? Have a look at this. Which direction is it going? Up or down? Let me know. Yeah, it's down, isn't it? Right, it's down. All right. Now, why am I asking this obvious question from you? Okay, let's just say that at this point, somebody came up to you, or maybe you read about it in the newspaper somewhere, that the PE ratio, the price to earnings ratio, don't worry if you don't know what that is. That doesn't matter, okay? Somebody said, hey, the PE ratio of the stock is pretty good. Or maybe the dividends of the stock are pretty good. Okay, well, let's just think about that for a second. Does that really matter? No, because where is this stock going here? Well, it's going down, okay? So I'm not interested. Let's say a couple of months later, we're talking about here, over here, okay? Bloomberg announces on his TV channel that this is the stock to go and buy it. Basically, they give a recommendation on it, say, hey, it's a great stock, you should go consider buying it. Okay, does it really matter what they say? Because have a look at this stock right here. Where is this stock going? Yeah, it's going down. So do we really care? No. A month later, okay, 1 month later, the stock, the company of the stock, of course, they release an earnings report, and they say that the company is doing really well, and the projections are this company will do even better in the next few months. Now, look what happened next. The market, the stock, still goes down. Now, why would the stock go down despite good earnings report? Because you see, this is why markets are irrational. Stock market is completely irrational because the one reason could be that investors, the shareholders, were expecting much better results, much better earnings reports than the one they got. So the earnings report they got was not very impressive at all. And that's not all. It could be because their expectations, their long-term expectations, were this stock is just going to go down. So that's what I'm talking about, guys. It does not matter what the earnings report is, Bloomberg recommendation is, or the PE ratio. As far as we're concerned, this stock is trending downwards. It's just going down. As far as I'm concerned, if I'm going to buy this stock here, I'm going to lose money. Okay? So that's one of the important reasons I want to make sure you understand here right now. And we'll talk about this, by the way, in much more detail in the webinar. Have a look at this now. This is the Dow Jones Industrial Average. This is the U.S. markets. All right? And this is this is 2009, and this is 2008. Notice that in 2008, the market crashed, reached a bottom in March 2009, and then headed upwards. But if you remember 2009, you probably remember a lot of people out there who were just really gloomy about the state of the markets. The fact is we're in a recession. And but the fact is, guys, that despite the fact that everybody psychologically was gloomy about the markets, the fact that we were in a recession, what did the markets do? Well, the markets went up. Right. In fact, this is one of the biggest rallies we've seen in the stock market ever since the 2008 crash. So, again, this is another reason why we look at the charts, because expectations and the way people think is a lot different from what the reality could be. So why technical analysis? Well, here's a question I want to ask you. Who do you think determines prices? Yeah, people, us. We determine prices, all right? So that really it's not what a stock is actually worth. It's what people think it's worth. Let me tell you, I sometimes sit down with friends of mine who are not, some of them are not traders. And they will talk to you endlessly about what a stock is really worth or what actually is worth. The fact is, it doesn't matter because what people think it's worth is what really is important. And a company can receive fantastic fundamental reports, but a stock may go down. Okay, it may not be good to buy, as we've seen already. It's a good example. Why? Because a stock may already have rallied on the news or expectation of the news. All right. So again, this is why, as we've heard, there's a famous phrase that says, "Buy on rumor, but sell on the news." Because by the time the news is announced, it's too late. Okay. Now, if you want to do me a favor right now, get your pen and paper, write this down. All right, this is a very important piece of this webinar. There are two types of information. There are two kinds of information, all right? Information for the masses, information for the classes. It's one of my favorite quotes by Alexander Elder, okay? Now, what does this mean? Okay, information for the masses is pretty much the information that everybody else gets, the herd, basically. I know it's an ugly word to use, but that is the truth. What is information for the masses? We're talking about information that you get from news channels, newspapers, television, magazines, all this kind of online, yes. Am I talking about financial newspapers too? Yes, I'm talking about them as well. This is the kind of stuff that the average person gets their hands on what's going on in the financial world or about stocks. And you're probably wondering, well, what about CNBC and Bloomberg? Okay, here's a question I want to ask you. How much time do you think professional traders spend watching CNBC and Bloomberg? What do you think? Yeah, how much time do you think I spend? Yeah, it is exactly 0. You want to do me a favor? If you got CNBC and Bloomberg, switch them off. All right. Actually, you know what? There's a way you can use them too. If they ever give you a recommendation on a stock, do the opposite. I guarantee you'll make money. I guarantee you do the opposite of what these guys tell you, you actually will make money. All right. So they're mostly garbage. All right. So this is, again, what is this? This is information for the masses. Okay, for everybody else. So you want to make money, you got to have information for the classes. This is people in the know. But I've got some bad news for you, by the way. You see, information for the classes is mostly illegal. Okay, yeah, we're talking about insiders here. That's right. So we're talking about inside information. But here's the reason why I prefer technical analysis. Because, you see, for me, from my point of view, technical analysis, as long as you do it well, is the closest you're ever going to get to insider trading without breaking the law. Because the way I see it, whenever the smart money, so again, we're talking about institutions, the big funds, whenever these guys make decisions, they leave footprints. All right? So what I'm talking about is many years ago, here's an example. Many years ago, 20, 30 years ago, before technology, the internet and everything else, in those days, these big guys, these big funds, could make decisions, and they could hide their footsteps. They could hide their trails. Nowadays, it's much more difficult. They can't just do it that way. So when they make decisions, they leave trails, price patterns, signals. So our job as traders is to identify where those footprints are heading to. Okay? So if you can become really good at charting and about technical analysis, you can then have an idea of where these guys or what these guys are up to, and what they're buying, what they're selling, and what that means. Okay, so if you like detective work, this is very interesting. Must be interesting for you. And if you're wondering, well, hang on a second here. What about fundamental analysis? Do we just ignore the fundamentals? Well, no. We still look at some fundamentals. What we do is we pick stocks in the strongest sector. Okay, so if we're going to pick a stock, we pick them in the strongest industry. All right. So also, if you ever have a hunch about a stock or a company, the first thing I would do is I would check the charts, to kind of give you more confirmation about where that company or where that stock is going. All right. In fact, I'll tell you this: if you don't check the charts, it's a bit like a doctor who gives a diagnosis on his patient, but he never takes the patient's the temperature. So you want to make sure you check that. Okay, guys. Let's go to some interesting stuff now. What makes a good stock? Okay. What makes a good stock are, in my opinion, first of all, you got to have a rising price trend. Okay, a rising. If you don't know what a price trend is, don't worry. We're going to talk about this today. 2, a rising volume. Again, we'll discuss this today as well, what rising volume is. Strong momentum and a strong sector and industry. And yes, finally, you got to have a strong market. Let me ask this, by the way. Do you think right now, in the current situation, the current market we have at the moment, do you think it's a strong market or a weak market? What do you think? Or maybe somewhere in between? What do you think? Write me down what you think. Yeah, put it this way. It's not a strong market, all right? We're, at the moment, in I would say this, we're in a period of great uncertainty, all right? With all what's going on in Europe, everything going on right now and around the world, I wouldn't say it's a strong market. I would say a strong market is what we had back in the early, from until 2006. Until 2006, we had a pretty strong market, and then pretty much everything unraveled from there. 2009 and 2010 were not bad either. Okay, they were pretty good markets too for buying stocks. All right. So let's talk about, first of all, a strong sector and a strong industry. Okay, I would say this, write these down. These are two important websites that you need to visit to identify, and I'm going to show you how to use them to identify strong sectors. Mushin, yes, it is being recorded. Yes, I've got a question here. It's being recorded. Yeah. So we've got marketwatch.com/tools/industry and leadingtrade.com/market map. Okay, let's have a look at the first one. So go to the first web link that I've just given you right there. Okay, I'll put it back for you here in case you missed it. All right. Anyway, so the first one you go to on MarketWatch, this is a fantastic tool to identify which industries are doing quite well right now, or extremely well. And I would say this, put this to 3 months. By default, it should come to 3 months anyway, but just in case it's not, make sure you're looking at 3 months worth of data. And you can see the last time I checked this, it said these were the top performing industries. You got industrial suppliers, made 13% the last 3 months. Gold mining, not surprising there. Gold mining has done 10% the last 3 months. You got toys index. Again, not surprising either. What's happening, just getting around Christmas, I guess. And utilities. And that's not surprising either. We're going to look at this as well. Now, also go on the second link I'm giving you to look at the market maps. Market maps are what you see here. It's a map of the market. Okay? A map of the market. So basically what we have here is all the markets. We got all the sectors. Healthcare here. Industrials are here. Materials are over here. Consumer staples are over here. Okay? And every single sector, as you see here, has its own companies inside it. The squares you see here are the companies inside these sectors. All right. Now, here's how you interpret this. The brightest greens show to you the companies doing the best. Brightest reds shows to you companies doing the worst. So really, if you had to pick a sector, you want to have the ones with greens or reds. Yeah, more greens, right. So have a look at this. You tell me, which sector do you think has the highest ratio, okay, listen to what I'm saying here, has the highest ratio of green compared to red? What do you think? Write me down your answer in your question box. Good. Kate's right. Steve's right. Ignacia, you're right. Well done. Marilyn, you're right. Gabrielle, well done. Jed, well done. Okay, good. Yes, guys, so utilities is the correct answer. You got it all right. Utilities, yeah. Also, utilities is pretty good. Consumer staples is not bad either. That one's doing good as well. Healthcare, too. Now, let me explain why. Again, the reason why utilities are doing quite well, let's not forget this. Even in tough economic times, in recession times, do you think people still need things like water, electricity, gas, telephones? Yes, of course. Those kind of industries still do quite well in recession periods, in economic, oops, went too far, in recession periods. Also, consumer staples, what I'm talking about over here is things like tobacco, alcoholic beverages. Why would those things do well in a recession? Well, again, let's not forget. When people in a recession, in an economic crisis or in tough economic times, people get stressed. As a result of getting stressed, they do things. They have behavior patterns to relieve that stress. What do people do to relieve the stress? Well, they smoke more. All right, they drink more. Okay, so you see tobacco industry is doing quite well. Alcoholic beverages doing quite well. Breweries. And, of course, when people do that kind of stuff by smoking more and drinking more, well, where do you think they end up in the end? Right. Hospital. So you see healthcare, those kind of things doing quite well. All right. So I hope that kind of is clear here. Somebody just written me a question, comments, and people are depressed. Yeah, that's true. I guess they do as well. Okay. Okay, let's have a look. I'm going to start now looking at technical analysis and the chart analysis. All right. If you were to draw me the Acropolis of the technical markets or technical analysis, the Acropolis, as you know, is that building in Greece. Now, I would say there's 4 pillars under this Acropolis or this structure. The 4 pillars of technical analysis are price, volume, momentum, and risk. Okay, and we're going to take a look at each one of these tonight as much as we can. So let me just explain to you some key concepts before we start. First of all, Here's a question I want to ask everyone here. Okay, the market consists of, what's the next bit? What goes here? What does the market consist of? Okay, somebody wrote suckers. Yeah, that's true. There's a lot of people out there who are suckers. Yeah, people. Yeah. So yes, buyers and sellers. That's correct. Buyers and sellers. So the next question is, price is determined by. So who determines the price then? What do we think? What goes here? Yes, people. Buyers and sellers. Yes, exactly. So supply and demand. Exactly. Well done. So supply and demand determines the price. So here's the next bit. Supply and demand is determined by what? What determines that? Right. Yes. Yeah. People. Yeah. So I'm just reading out your questions and answers here. So the aggressiveness of buyers and sellers. Yeah. So how aggressive, how committed buyers are and sellers are to a particular market or bulls and bears determines how, of course, supply and demand is going to work out and which direction a stock is going to go. Now, first of all, I know that some people don't understand. I know if you're a beginner, certainly you probably won't know what these terms are. By the way, I am assuming for this webinar that pretty much everybody is a beginner in the market. So I know that some people who are listening to this webinar maybe just be more experienced, but I hope you bear with me and you'll be patient because I'll have some material for you as well. Okay, so what's bullish mean? Bullish simply means buyers are more aggressive than sellers. So buyers are in control of the market. And that means the market has a greater probability of rising in that kind of market. Bearish just means the opposite. So sellers are in control. The sellers are more aggressive than buyers are. All right? So the market has a greater probability of falling when the market is bearish. Okay? Now, one thing I want to do also, first of all, is I know some people don't understand what bar charts are, because especially if you are a beginner, you probably won't know what on earth these bars mean. So let me explain them to you. When you see bar charts, essentially what you're looking at is a vertical line with a tick on the left-hand side and a tick on the right-hand side. Now, this little tick on the left shows to you where it opened up and where it closed. Okay, so that means when you see a bar like this, what that means is the market opened up here at these lows and closed here. Similarly, when you see a bar like this, that means it's a downward day. The market opened at this price, went lower, and closed at this price. So if you just go back on this chart here, this is Google. Look at Google here. You see that this bar, look at this big, massive bar you see here. That tick on the left-hand side shows the price. Okay, the price opened at a 640 on that day. Okay, so this is one day of trading. Okay. The market opened at this price and then went lower and closed at these levels here. Okay, so I'm hoping you understood that. Then we have something called candlestick charts. I use these two for a lot of trading. A lot of traders, of course, look at candlestick charts. So again, if you're a beginner and you're not familiar with these kind of charts, let me explain to you what these mean, what these bars mean. It's quite simple to understand, by the way. Just think of them as open windows and shut windows. And what basically mean is if you see a bar that's hollow, okay, like this, just think of it like an open window, okay? When you open a window, what do? Well, you lift the window, right? And if you remember those old-fashioned kind of windows, the way you open them is you have to lift them up. So an open window means the market went up on that day. Okay, so the market opened up at these lows and closed at these highs, these levels here. Similarly, when you see a bar that's filled in like this, that means the market opened up at these levels here and then closed here. Okay, so again, an open window, market goes up. A shut window, market goes down. So, and sometimes you also see these as well. You also see green and red bars. This kind of makes it easier because the green ones usually mean the market went up on that day, and the red ones mean the market went down on that day. So have a look at this. This is Google. Let's have a look at this bar you see here. That bar represents what happened on one day of trading on Google. Essentially, that's I think that's the 18th of January. Okay, so that means essentially the market, Google's share price opened up at 625 around this level here. Okay, and then as you can see, open window, rallied higher and closed at around 640. Okay, so that's an up day. Now have a look at this bar, this big massive bar you see here. That's a down day, right, isn't it? So the market opened up at 640 and it's a shut window, so it went all the way down and closed at 615 around this region here, okay? So that's essentially what these bars really mean. It's the way you want to think about them, all right? Okay, so let's continue. All right, so now we're going to talk about, okay, we've got some questions coming up here. What the line above and below? Okay, if you have a question and maybe just want to hold on to them, hold on to your questions, guys, and give them to me at the end of the webinar. Okay, don't worry, that's fine. Okay, we're just going to continue. All right, let's talk about support and resistance now. Support and resistance, actually, guys, I would say this, by far one of the most important concepts of this webinar, and of course of trading in general, or analysis of the markets, is support and resistance. So pay attention to this webinar. Pay attention to this particular part of the webinar. It is quite important. Okay? So what's support and resistance? Basically, in very simple terms, support and resistance are the ceilings and the floor of the market. Okay? The floor and the ceiling. Think of it like this. Imagine this stock here. Okay? Let's just go back here. This stock rises, hits the ceiling, and then bounces off, goes and hits the floor, and then bounces off that. All right? Now, essentially what we're talking about here is a ceiling and the floor of the market here is not as concrete or is not as solid as you think it is. All right? So I know a lot of books and a lot of materials on the internet kind of give this idea that they're pretty solid and the market is going to bounce off from it. That's not true. Think of them not so much solid, but more made of more flexible material, more fluid materials here. Okay. Now let me just give you an example of what I'm talking about here. So support resistance, quite simply, means the price levels at which price stops going up or down. All right. In other words, these are areas where buyers and sellers, so bulls or the bears, meet at these levels. They do battle until one side will win. One side will take control, either the buyers or the sellers. Okay? Whichever side wins will determine which direction the market will go. All right? So let's have a look at one example I'm talking about here. So here's a typical market. Okay, so the stock is going up and down here. Okay? And we've drawn these levels for you. We've drawn the resistance levels and the support levels. So what support and resistance simply means is these are areas where buyers and sellers are in agreement, when buying power and selling power are in equilibrium. All right? So let's just give you an example to you. Have a look at the stock. Okay, this stock, just let's imagine the stock here from the start. It rallies from 122, rises higher, and goes to 132. First of all, why is the stock going higher? Because buyers, the bulls in other words, believe the price is low. So the buyers, the bulls in this market, they're saying, look, this stock at this price levels are pretty cheap. And they start buying. There's a lot of demand for the stock, and they push it up higher. And what happens is eventually the buyers and sellers come to an agreement on the price. Okay? That's where they reach resistance. They do battle here. And what happens is the sellers take control of the market. Okay, so the buyers push up the price, reach a point of resistance, and eventually, as the price rises, the bulls become less aggressive, bears become more aggressive, the sellers become more aggressive, and they take control and push the price down. But as you'll notice, the stock comes down here, reaches the previous levels on the stock, 122 in this case, and at this point, the bulls become more aggressive, the buyers, and they push the price up. Okay? And here's the important point I want you to appreciate. This is the key thing I want you to appreciate. The market has a memory. Okay? The markets have a memory of the price. Why? Because the markets are made of people. People have a memory. Now, let me just explain to you what I mean. You see, imagine that you had bought the stock at 122. You then, you see, as the stock rises in value and goes to 132, right? And if you're the kind of person who doesn't look at charts, you know, because let's not forget this, a lot of people don't look at charts. But you may notice in a newspaper or maybe on TV or somewhere, you read that the price of the stock that you bought has reached 132. And that was the same time, the same price, by the way, when the stock fell the last time. All right, so you think to yourself, oh, hang on a second, the last time the price reached 132, that stock fell in value. So you see what happens is at this point, buyers and sellers come again to do battle. And again, what happens is buyers and sellers come to an agreement on the price, and sellers at this point, the sellers take control of the market and push the price down. All right. And again, this kind of battle continues back and forth until what happens here, there's a breakout from resistance. Now, why is it there's a breakout from resistance? Because at this point, the buyers believe that, well, at 132, the stock at this point is still pretty cheap. It's undervalued. Okay. Maybe there's some good news comes out on the stock. Maybe there's some good news in the stock market comes out, and that pushes the price much higher and breaks apart from this resistance levels here. Okay. Now, if that still sounds like gobbledygook to you, don't worry, because I'm going to show you some examples of this in action. All right. So again, just think of these levels, this resistance level and support levels. These are areas where the markets are very likely to pause, and may even reverse from these levels. Okay. Some key levels for you to remember: highest highs and lowest lows. Any major top or bottom, these are key levels of support and resistance. Okay. Let me show you what I mean. Okay. I know some of you are writing this stuff down, but let me just give you some examples here. Okay. Have a look at this. Imagine that you are considering buying the stock at this level here. Okay. This is the stock price. Okay. This is the chart. Now, remember, the key resistance and support levels for you to note are highest highs, lowest lows, or any major peak or bottom. Okay. Have a look over here. Okay. If you're going to buy the stock, if you're considering buying the stock at this point right there, where is the highest high? Well, there it is, right? Where it says R. R, as it says over here, is the highest point in the market. That's right. So if the market rallies higher, when it reaches the highest highs here, okay, that's going to pose a level of resistance on this market. Okay, remember, the markets have a memory. Investors have a memory. They remember that last time the market fell was at this level here. So when the stock price level reaches these highs, it's quite likely that this level is going to pose resistance to it. Now, what if the stock went down? If the stock goes down, where is going to be the support? Where is going to be the floor? Right. It's going to be, first of all, the lowest lows. The lowest lows of this market is here, and any previous peak or bottom, which is going to be here. Okay. I hope it kind of makes sense to you right here. Okay. Let's have a look at an example. All right. I have here for you the stock of Apple. Okay. Have a look at this. Apple here is, as you can see, kind of bounces up and down on this kind of price level. And let's say you're considering buying Apple. All right. You're considering buying Apple at 95. There it is, $95. Now, by the way, this is 2009, in case you're wondering. Apple, $95 is now $400, right? Yeah. Well, at that time it was $95. Let me ask you this. Based on what we've just discussed, that the resistance and support are highest highs, any previous, and of course any highest highs, lowest lows, and any previous peak or bottom, where do you think is going to be the resistance level for this stock? Write me down on your question box, where do you think is going to be resistance on this stock? Okay, some of you are writing 103, 104, 98, 105. All right, okay. Well, the answer is yes, because look, you're absolutely right. Remember, the highest high of this stock at this particular moment here is about 103, 104 region here. By the way, don't forget this. Resistance and support, they're not lines. Okay, don't think of them as lines. They're not like some straight line you can draw. They're more like areas, boundaries, zones. They're quite blurred, by the way. All right? So if you said to me, let's have a look here. Okay. If you said to me, yes, 103, you're absolutely right. What happens is when the stock rises these levels here, this level, 103, 105, is going to pose a massive resistance to it. Okay? So again, this is going to be an area where sellers may take control of that market. Okay? Oops. So where do you think is going to be support? What if the stock didn't go up? What if the stock instead went down? Right? Where do you think is going to be support? What price level do you think is going to hold a floor on this market? Okay, I'm getting 80, 78, 85. Okay, some of you are writing on 87, right? Okay, yes. Yes, okay, good. Those of you who said around this area, certainly the first area of support is going to be this region here, okay? We had this previous low here, okay? And yes, then it's going to be about this area as well. So definitely 85 and 80 is going to be this area of support. So when this stock comes down, again, this is an area where buyers, potentially the bulls, could take control of the market, okay, and pose support on this market. So the market may pause. Apple may pause at this point here, all right? So why, again, some of you probably, again, I appreciate some of you probably listen to this. Maybe some of you beginners are listening to this. And you're saying to yourself, well, Alessio, okay, but so what? Why does it matter whether there's going to be resistance or support? Why does it really matter? Well, here's the reason. Look, if you're considering buying a stock at this point, 95, your question should be this: what is my risk? What is my reward? Your reward technically could be nothing more than from 95 to 105. That's it, from here to here. Okay. Because remember, this is going to be a resistance level. This could be the level where the market, the stock, could actually find massive resistance to it and go just reverse downwards. So, in other words, your reward could be quite limited. Your upside could be quite limited here. That's the reason why we're talking about this. All right? That's the reason. Whenever you're entering a market, whenever you're buying a stock, the first thing you should always ask yourself is, well, what is my risk? What is my reward? All right? That's the reason why we're talking about this. All right, so let's have a look at what happened next. All right, there it is. The stock just took off, and it broke out of resistance. Why? Because the buyers here were quite aggressive. They considered the stock at 105 to be quite low and undervalued for this particular period, and they just pushed out of that level here. And that's what's called a breakout, by the way. A breakout occurs when price moves through either support or resistance. So either buyers or sellers become more aggressive based on market events. All right? Okay, so let's go now to trends and oscillations. Trends and oscillations. Okay. How's that so far, guys? I mean, are you all getting this? Yes, guys? Is this all sinking in? Yeah? Oh, somebody wrote down here, hang on a second here. Yes, there's a point here from Kurt says, it's easier when you see in hindsight. True. Everybody looks like a genius in hindsight, but that's the whole point of this webinar, to show you that we're going to show you there's a lot of stuff we can use to find out exactly what markets are like, what they're going to do, or what is likely to happen before it actually happens. So again, yes, things always look good in hindsight, but the whole point of technical analysis is to show you how to determine direction of the market before it actually happens, before it's too late for us to act. Okay, this next area is actually going to be quite simple to understand, hopefully, so I'm hoping everybody here is going to follow me quite simply. Okay, trends and oscillations. All right, markets or stocks in general move really in two major ways. I'm talking about there's two kinds of behavior patterns, or two main ways, put it this way. The first one is trending up. Well, actually, when you think about it, there's three ways they can act. They can trend up, they can trend down, or they can do neither, just bounce up and down. All right. The point is they can either trend in the upward direction, trend in the downward direction, or just simply bounce up and down, oscillating in a range bound. Okay, so let me just give you an example. Have a look at this. This is Walmart. Walmart, in this example, would you say that this stock was oscillating or trending? By the way, one thing I didn't mention here, probably I should have done, is when I say trending, what that means is the stock is moving deliberately in one direction. Okay, did you get that? Trending means the stock or the market is moving deliberately in one single direction, whether it's up or down. Now you can see over here when a stock is oscillating, there is no trend bias. It's just going sideways. There is no particular deliberate or decisiveness in that move. So going back to Walmart, what do you think, guys, here? Do we think we have a trending market here, or do you think we have an oscillating market here? Yes, well done. A lot of you said oscillating. Well done. I read your comments. Well done. It is oscillating or bouncing up and down. What about this one here? This is Baidu. Do you think Baidu was trending or oscillating here? What do you think? Yes, trending. And which direction is uptrend? Yes, it's an uptrend. Nice, very clean uptrend you can see here. Now, the question you're probably wondering, or you might be wondering, is why do we have to know? Why do we want to know whether the stock is trending or oscillating? Okay, have a look at this. This stock here comes down, hits a floor or a bottom here, okay, and it starts to rise, okay. One of the things, first of all, one of the things we never do is we never try to buy a stock when it's going down. That is pretty much like what we saw earlier on the stock we saw earlier today in this webinar, when that one was just going down. That is pretty risky. It's like catching a falling knife. But over here, okay, have a look over here, that is the kind of area we want to buy when a stock reaches a bottom and starts to go in our direction. And when a stock is trending, we also want to know when the trend is going to finish or likely to finish, okay? So that we want to know when to sell the stock as well. So question you're probably wondering is, how do we know the shares change direction? How do we know the trend has changed direction? Okay. All right. I'm going to give you some simple rules to identify how to find out when a stock is trending down or trending up. All right? And it's very simple. You see, guys, when a stock is trending down, let's just have a look at this. What you have to look at is the peaks or the top of that move, okay? So look at the tops or the peaks on that market. If the tops are getting lower and lower, that means the stock is trending downwards, okay? And what you can do is draw a line connecting the tops, and that shows you that the stock is trending in a downward direction. Conversely, when a stock is trending up, what you got to do is draw a line and connect the bottoms and see if the bottoms are going up. If you see a series of higher lows, that stock is trending up, and if you see a series of lower highs, you see lower highs is trending down. So the rule is bottoms up for trending up, and or tops down when the stock is trending down. All right, so you get that? Bottoms up when the stock is trending up, tops down when it's going down. Have a look at this. This is a stock of Research in Motion, RIM. Okay. Now have a look over here. Just have a look over here when you see the stock. Before I show to you the trend on my chart, what do you think? Do you think the trend here was in a downward direction or upward direction? Well, yes, exactly. I mean, it's pretty obvious. What are the highs doing here? The highs are getting lower and lower. Okay, draw a line. There you go. Tops down. It's going downwards. Okay, what about over here? It's trending up, isn't it? Right? Why? Well, have a look at the lows. The lows are getting higher and higher. Look at the lows here. It's getting higher than that one. This low was higher than the previous one. This low was higher than the previous one. Draw a line and you'll see exactly what I mean. All right? That shows to you that this stock was trending higher and higher throughout this particular period. Okay? Does that make sense? Good. All right, let's continue. Now have a look at this. This is Schnitzer Steel Industries. First of all, what do you think? Was this stock trending or oscillating? What do you think, guys? Let me know. Trending or oscillating? It's trending, right? Exactly. Trending up. Yes, exactly. Have a look at the lows. Look at the lows the stock is making. Are the lows getting higher or lower? Well, again, it's pretty obvious. It's trending up. Look at the lows here. That was higher than the previous one. That low was higher than the previous one. And we just draw a line here. There you go. You can see a pretty aggressive trend in the upward direction. Okay. And yes, this keeps making higher lows, bottoms up. And now here's an interesting point here. You probably have heard this phrase that says, the trend is your friend. Well, that's not true. The trend is your friend until the end. All right? Yes, until it ends. Exactly right, Steve. Yeah. The trend is your friend until the end. One of the things, see guys, one of the things I always look at, and I want to write this down, whenever you see a stock that's been in a continuous trend, you got to ask yourself this question: how long has this stock been in a trend for? And also, is it likely that this stock is going to finish this trend? Right? Right. But how can we have some clues? How can we have a clue that this stock is trending toward, well, how can we have a clue that it's about to end its trend? Well, by drawing these trend lines, and when you see the stock breaking this trend line, that is your first clue that this stock is quite likely to be finishing its trend. In this case, you can see it's a pretty aggressive trend reversal. Okay, this trend line, you see it broke right there on that bar, and then continued, in this case, you see, to completely reverse this entire trend. And by the way, guys, that is exactly why the strategy which a lot of people use, which is called buy and hold, does not work. By buying and holding a stock, if you have no exit strategy, people who have no exit strategy whatsoever, they're essentially going to lose their money one way or another. Because anybody who bought the stock at $50, as you can see here, would have made money for sure when it went to eventually to 110. But you see, because they have no exit strategy, they continue to hold the stock when the stock plunges, and really they just end up with nothing. Or maybe worse, they end up with a loss. Okay? So that's why it's important for us to identify trend reversals, so we don't end up losing everything we have, or all our profits. So a trend line is also support as well. Remember earlier we discussed support and resistance and floors and ceilings? Well, guess what? This trend line, when we draw these trend lines, these also provide us with support. Notice that this particular part, in this particular point here, the stock came here and paused at this price level here, okay? Okay, let's continue. Have a look at this. Does anybody want to have a guess as to what I'm looking at here? Anybody want to write down what it is I'm looking at here? I know that some of you probably will look at the my cheat and look at it. Yes, it is. Yeah, it is gold. Yes, it is indeed the price of gold since 2009. All right. Now, what do you think, guys? I mean, has gold been in an oscillating market or in a trending market? Yeah, it's in a trending market, isn't it? Yeah. How do we know it's been trending upwards? Well, again, what do? We look at the lows. The lows are continuously making higher lows, higher lows, higher lows. I mean, when you think about it, even this recent downturn we've seen on the gold markets hasn't taken out these lows, has it? We're still trending higher, aren't we? Yeah. So, I mean, this low it made, this recent low, is still higher than the previous low here, okay? Draw a line. So we are still in a pretty strong uptrend. I'm actually looking forward to gold actually coming and testing this line here. We haven't seen it test this line yet, so maybe, you know what? I think it could be in the making here to see it test this line at some point. All right, so we'll come back to gold later in the webinar. Okay, so here's a question I want to ask. So here's a question you could be asking yourself right now: How can we have more confirmation? How can we be more? Well, I don't want to say certain because there's no such thing as certainty in the markets. But how can we have more confirmation the trend has changed in our direction? We use two technical tools. We use two tools I mentioned to you here. The first one is called technical indicators, and the second one is called chart patterns. Okay. What are technical indicators? Technical indicators are tools that we use that tell us when to buy and when to sell into a market. Okay, the first one is called moving averages. All right, so let's have a look at moving averages first of all. All right, first of all, I want to ask everybody here, how many of you have ever used moving averages? If you have, put your hands up, because I know some people have used moving averages even though you may not have been trading before. Yeah, moving averages actually being used in other fields too, like mathematics, for example. Yeah, good. How many of you have never heard of moving averages before? Put your hands up if you've never used them before, or if you've never heard of them before. Okay, quite a few of you. Okay, quite a lot of you. Okay. Okay, good stuff. All right, now pay attention to this point. This is quite important. I want to mention to you here. I'm going to show you some interesting stuff here. So what are moving averages? What moving averages do is they average out the share price. That's what it implies. Okay, so this is the share price. As you know, a lot of share prices are not straight lines. They're zigzags. And what moving averages do is they basically smooth out the edges, smooth out those edges you see on the stock market. What we use is two moving average lines. So we use one short-term moving average and one long-term moving average. Now, what does that mean? Again, let me just mention this one more time. We take the average of the share price over a given period of days, and we plot this over the chart, over the stock price. By doing this, it gives an early indication, okay, of where this stock is most likely to be heading. What's important for us is these crossovers. You see this crossover here? Okay. When you see a crossover of the moving averages, that gives you an indication of a buy point. And so basically what that means is when the short term goes above the long term, when the red goes above the blue here, that's a buy signal. So where do you think is a sell signal then? If that is a buy point, where's the sell signal? Yes, well done. If you said here, if you said right over here, the opposite, you'd be right. Exactly. That's a sell signal right there. Okay. Now, let me just mention to you here, there's a famous guy out there. His name is John W. Henry. Because write his name down. John W. Henry. This is a guy. He used moving averages to make so much money. He was then able to buy the Boston Red Sox baseball team. Okay, this guy bought the Boston Red Sox baseball team based on the money he made using moving averages on his trading. And recently, I heard that he bought the Liverpool Football Club here in England. By the way, anyway, let's have a look at an example. Okay, this is a stock of Dollar Tree. Okay, Dollar Tree is one of my favorite stocks of the last year. This stock rallied, as you can see here. Let's have a look at the stock here. This particular company's stock price rallied from $45 about October of last year to about $80 just this year, in fact. Okay. Now, one of the reasons, as you probably know, why stocks like Dollar Tree do well in a recession or an economic downturn is that, well, if you've never been to America before, what Dollar Tree does, it's one of those stores where basically you walk in and everything is $1. Yes, one of you actually wrote down as a consumer staple. Exactly. It's one of the stocks in the consumer staple industry. In other words, yeah, exactly. If you live in the UK, it's like Poundland. Everything is £1 or €1, whatever you call it. Okay. So anyway, you walk in, pretty much everything is $1, and again, you can see that in tough economic times, people don't buy their stuff from expensive stores. They go to places like Dollar Tree, basically. Now, notice that it's all very well in hindsight looking at this and saying, oh yeah, great, this stock went from 45 to 80. Yeah, well, that's all very well. The question you're probably asking is, well, how could you have known in advance that this stock was going to rally higher? Okay, so what we're going to do is we're going to plot on our chart. Okay, somebody has written down here in Australia you have a $2 shop. Okay, interesting. Okay, I didn't know that. Okay, guys, what I'm going to do here is that I'm going to plot on my chart two lines, two moving averages. You ready for this? Okay, here we go. So what I plotted for you here is one short-term and one long-term moving average. Okay, one is red, one is green. Sorry, one is red, one is blue. Okay, so guys, I want to do an exercise. Let's do an exercise together. I'm going to move my cursor from the left to the right. As I'm moving my cursor, I want you to say to yourself, or shout this out loud as you can so you can hear it. Okay, and in fact, if you want, maybe you can write it down in your question box. Okay, what you would do when you'd buy and when you'd sell. And remember, all we're interested in is the buy point and the sell point. And what you look for is the crossover. Okay, the crossover of the moving averages. Okay, you ready for this? I'm going to start doing this for you. Go. Okay, that's a buy. Well done. That's a buy. All right, let's keep going. Let's keep going. Okay, so you hold and you hold until we reach, okay, sell. Well done. If you said sell, well done to you. Now notice what happens here. Look what happens here. The moving average is crossed over to the negative. In other words, we're looking at a bearish crossover. The stock plunges, goes lower, goes lower. Look what happens here. What's that? Is that a buy or a sell? It's a buy. Well done. If you said buy, congratulate yourself. Now you buy the stock at this price. Hang on a second here. Just 1 second. Okay, so you buy the stock at $50 and the stock rises in value. Okay, goes up, goes up, goes up. And what do you do here? It's a sell. Good. And then you buy it back again at 65. Okay, and there you go. It's a buy. And hold, and you hold, and you hold until now. And I think I've seen recently the stock price just made a bearish crossover recently. Okay, but I have to check that one more time. So have a look at this, and you'll see that this particular moving average crossover we just saw here, that gave us 1, 2, 3 profitable trades in last year. Well, since 2010, basically. Okay. So you'd have bought the stock at 45, sold at 55, then bought it back at 50, and sold it at 50, 65, and so on. All right. That's a pretty neat trade. That would have actually made you, let me show you, 78% profit in 1 year using moving averages. All right. I don't know how many saving accounts that you know of that would have given you 78% profit in 1 year, but okay. Let me just go on to this. So I hope you actually got that right, and that's essentially how we go about doing this. By the way, let me show to you now. Let me show to you now what we do to get these moving averages on our charts. Okay, so here I'm using TradeStation, and I basically use TradeStation for basically it's a professional charting software that I use for all my trading. And by the way, if you are wondering, what kind of charts and brokerages to use, stick around, because at the end of the webinar, I'm going to show to you which particular charting and brokerages I recommend to you. All right, the ones that I use, the ones the professionals would recommend you use as well. Okay, so stick around, all right? All right, so here on TradeStation, what you do here is you go on indicator, okay, and so you press this little. Basically, what you do is on this list you choose moving averages. Now, let me just show you the ones that I use for my moving average crossovers are not the moving average simple lines. It's not this one. I use the one down here. You see this here? It's moving average exponential. Okay, so not moving average simple, the default one. I don't use a default one. I use the moving average exponential. If you're wondering, well, hang on a second here, what's the difference? Well, don't worry. I'll explain this to you in a second. I'll explain this to you in a minute. Okay, so here it is. So I plot them on my chart. I put them on my chart. So here I'm using a moving average exponential. 2 of them, by the way. One is a 10-day moving average. One is a 21-day moving average. All right. A 10-day moving average simply means it averages out the share price for every 10 days going to the past. Okay? 10 business days, by the way, 10 trading days. It doesn't include weekends or things like that. All right? So what we do is just put them on our chart like that, and you go to the input section, just type 21-day moving average, and there's a section here that says color. Okay? You choose the color you want, and then you get the chart, you get the lines on your chart. Okay? So what are moving averages? A moving average is a line that smooths out the fluctuations in the stock price. Okay? So, for example, a 10-day moving average we discussed is an average the price over the 10 most recent business days. There are 2 types of moving averages. There's simple and there's exponential. All right? The simple gives weight to each day's prices, whereas the exponential gives extra weight to the recent prices. All right? So I like to use the exponential ones for the crossovers because they give extra weight to the recent data, not just to every day's data. Okay? They tend to be much more faster than the simple ones. All right. So I hope that that's kind of clear to everybody here. So here's what I would do. I would use a combination of 2 moving averages for the crossovers. Now, as you saw in the example I showed you, there was a 10 and 21. You can use 10 and 20. So write these down. You can use 10 and 20. You can use 10 and 30, or you can use 8 and 21. Okay? Did you get that? So either use 10 and 20, 10 and 30, or 8 and 21. In case you're wondering which one I recommend, the one that I use 8 and 21 because it's Fibonacci numbers. By the way, if you don't know what Fibonacci numbers are, don't worry about it. Okay, it's not important. If you've ever read those books by Dan Brown, if you read Da Vinci Code by Dan Brown, you probably remember he talks about some sort of numbers or sequence called a Fibonacci sequence. All right, these are just special numbers in nature. Okay, so that I like to use personally. So I find them less arbitrary than using just any number. Okay. And okay, so there we go. So as you can see here, I put them on my chart like this: 8 and 21 on my chart on TradeStation there. Okay. All right. So here's an example for you. By the way, is everybody here getting this? Are you learning, guys? Are you guys getting this? Yeah. Are you learning so far? Yes or no? Put your good stuff. Good stuff. Fantastic. Good stuff. Okay. Some of you are writing hell yeah. All right. Good stuff. Okay, have a look at this. This is Starbucks. Okay, Starbucks in the year of, so we're looking at Starbucks between 2007 to 2009. All right. Hang on, I've got a question here. It says, could you remind us, red is short or long? Well, yes, the red one that I showed you was a short-term one. Yeah, and the blue one was a long-term one. Okay, I mean, 21 moving average, I don't really think it's a long term, but relative to the 8, that is long term, yeah. Okay. Anyway, have a look at it. This is Starbucks in the year 2007, 2008, and notice what happened. In 2009, there was a bullish crossover, and we saw the price rallying from $10 to, well, what is it now? About 41, yeah. But look back at 2007. There was a bearish crossover. It was a bearish crossover when the short term went below the long term. The red went below the blue, right? And the stock just plunged from 40, 35 down to $10. All right. Okay. So have a look at this, and again, think to yourself: when would you have bought the stock? When would you have sold it? Right. So let's have a look. There's the arrows. Let's put the arrows there. Is that a buy or a sell, guys? What is that? Is that a buy or a sell? It's a sell, isn't it? Right? And over here, that's a buy. Okay? And notice over here, that's a sell. And it's a buy, all right? And, okay, but just have a look at this. I know what you're probably thinking. Well, hang on a second here. Wasn't that a bit weird that it just crossed over like that? It went to a sell, went back to a buy. Yeah, but remember, guys, we're not fortune tellers, okay? We have to stick by rules. When the crossovers happen here, that's giving us the first initial clue the stock could be reversing its trend. All right, so we wouldn't have known the stock is just going to reverse back up just like that. All right, so we need to be focused on being disciplined and following rules. Okay. One more thing I want to actually ask you here. Just want to mention. I want to ask everybody here a question. Let's imagine that at this point of the stock price, let's say CNBC or Bloomberg or some other financial expert or guru came out and said to you, yeah, this stock is now pretty much undervalued at this price. Let's have a look at this. At this price is 25. And yeah, go ahead and buy the stock. It's undervalued. All right, that's what they might tell you. Or maybe you might look at this or maybe some other person might look at this and say, oh, it's going to bottom out at this point. Now, here's a question to you I want to ask you. Would you have bought the stock? Yes or no? Would you have bought the stock at this point? Yes or no? Well, you see, here's the thing. Okay, let me just have a look at your answers here. Okay. Well, no. Listen, here's the thing I want to tell you right now. Write this down. Do not listen to your ego or your opinion or anybody's opinion. Listen to the market. Okay, let me just repeat that. Listen to the market, not your ego, not your opinion, not anybody's opinion. It doesn't matter, okay? The market is telling you that it was not ready yet to go up. So why would you care what CNBC or Bloomberg is telling you? Yeah, that's right. Follow the charts. Follow the market. The market is saying to you, hey, look, I'm pausing here. I am making a bit of a pullback, but I'm not ready yet to push higher here, okay? So as far as I'm concerned, I'm not going to touch the stock. The moving averages here are still pretty much looking bearish. We're still looking at a bear market here. So For me, that would have been the first initial sign this market is going to rally higher. So that would have been a buy point for me, not any point here. As far as I'm concerned, the only people who are losing money at this point are basically the amateurs who are thinking to themselves, oh, this is a bottom. Oh, that's a bottom. And that's a bottom. And what was happening is these guys are just losing money. Every single point, they're saying bottom, bottom, bottom. Okay? Okay, here's a question I want to ask you here. Could you have made money when the shares were going down? And here's a question I want to ask you, yeah? Because remember, we can make money when shares go down, can't we? But how? Well, here, write this down. You can buy puts on those shares. Okay, puts are option contracts. Yes, you can sell short. Well done. So shorting the market, buying puts in the market. That's why you remember, a lot of people didn't understand what I meant by that on the BBC video. So when I went on the BBC video and said, "Hey, I want the market to crash. I'm looking forward to a market crash." That's what I was talking about. I was talking about making money when the markets go down. So a lot of people didn't understand that. I'm just going to say, well, how does that work? So yeah, again, by buying put options, by selling short. By the way, don't worry about those. Don't worry about that right now. We're not going to discuss this right now. What we're going to do is we're going to have a separate webinar just on those things, just on those strategies. So one of the things I want to tell you is in the pipeline, I'm going to do a separate webinar on some fantastic. I'm going to show you some fantastic strategies on how we can make money when markets crash. But just make sure you understand this right now. Buying put options, these are instruments that make you money when shares go down, all right? So let's continue. Have a look at this, guys. This is a stock in the Hong Kong Hang Seng Index. Last year, I remember August last year, I went to Hong Kong, and we were doing a webinar we were doing a seminar in front of people in Hong Kong, and people there were quite, I can tell you, they were quite interested in the fact that the very same strategies we've been using in the U.S. and the U.K. for making money in stocks also work in the Hong Kong markets. I just want to ask everybody here, how many of you, just out of curiosity, put your hands up. Put your hands up if you are in Hong Kong right now. Anybody in Hong Kong right now here? Yeah? Okay, quite a few of you here. Okay, fantastic. Good stuff. Okay. Where are my Australians here? Because I know Australians live pretty close to Hong Kong, right? Aussies, guys? Where are the Aussies here? Okay, good stuff. Fantastic. Okay. Now have a look at this. Let's show we do the exercise again. I'm going to move my hand. I'm going to move my cursor from the left to the right. You tell me when you buy or sell. You ready? Okay. Should we do this? Go for it. So I'm going to, just 1 second, and start going now. Good stuff. Buy. Buy, hold, 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 and sell. Right there. Good. And buy right there. Well done. And hold and hold and hold. Sell. Good stuff. So if you got that right, give yourself a pat on the back, whatever. By the way, this is something I want to make sure you understand here. Write this down. You do not make money by trading in and out of the market. Because I see a lot of traders do this. They buy and they sell. They buy and they sell. In and out. That's not how you make money. You make money by holding, not by trading in and out every single time. Okay? When I say by holding it is when you see a buy signal, you buy. You hold until you get your exit, your sell strategy. You don't sell just because you made money. That doesn't make any sense. Because, the amateurs, you know what they do? Amateurs think to themselves, okay, I bought at 200 and I made some money here. I'm going to sell. Well, why are you selling here? The market has not told you it's a sell point yet. Listen to the market. Listen to the market, not your ego, not your voice inside your head that says, hey, I'm going to sell to make some money here. No. Because otherwise, you're missing out on the opportunity to make even more money here. And that would be the sell point. That is the exit signal. Okay. Good stuff. Now let's go to the next. Okay, that's 2 profitable trades here, guys. 2 profitable trades that made you 223% profit 10 minutes. Why 10 minutes of work? Because guess what? I mean, how long would it take you to actually put some moving averages on your chart? The funny thing is, you guys, the one thing I can tell you is this. A lot of people always complain about the fact they don't have any time, they don't have any money. But, those very same people who say they don't have any time spend about 2 hours a day watching TV shows. You know, the crap you see on TV, basically. This is the thing. In the seminars I do, people always come up to me, oh, I don't have any time. But let me get it straight. If you don't have any time, why are you spending every single day watching those horrible TV shows like Dead Enders and Coronation Street? If you got time to watch those TV shows like Big Brother or X Factor, you got time to do some research, buddy. Okay? Switch off your TV or basically record your shows and get down to some work. Okay? You want to make money in this market? You want to learn how to have more money and make a success of yourself? Switch the damn TV off and go to your library, read some books in the markets, or come to these webinars. Listen to me. Listen to the market again. Not some next door neighbor. All right, not X Factor. Okay, X Factor is not going to make you money. All right. Just in case you're wondering what X Factor is, don't worry. It's like American Idol or American whatever. Okay. One thing, guys, very important. I want to make sure you understand here is this: there is no BS in this seminar or this webinar, which is. I want to make sure you understand something very important here. Let me show you something that a lot of books and a lot of online materials you read will not tell you, which is this. Here's a huge warning about moving averages. Listen, I've gone through a lot of books and online materials, and they will not, a lot of them don't even mention this to you. But I want to make sure you get this right now. So write this down. Moving averages only work when stocks are trending. They do not work when stocks are oscillating. All right, did you get that? So we don't ever use moving averages when they're oscillating. We use them when they're trending. All right? So why is that important? Because let me tell you, if you use moving averages when stocks are oscillating, you'll be ripped apart. You will lose money so fast you won't even know where you're coming and where you're going. Okay? Let me just give you an example here. This is Goldman Sachs. Look at Goldman Sachs here. Look at how the market was behaving. It was oscillating, wasn't it? And by the way, yeah, it's a huge chop, right? And you see, I see a lot of traders do this. They use moving averages for oscillating markets. But you shouldn't do that. You should never use moving averages for oscillating markets. You'll lose money big time. And notice this. I mean, this would have given you buy signal, buy, sell, buy, sell. I mean, paying commission as well. Every single point here. I mean, you're going to lose money, be slaughtered. So I know what you're probably thinking. Well, how will I know if the market is about to go into choppiness, you know, bouncing up and down or range bound before it actually happens? Okay. Well, I want to share with you guys. I want to share with you a very key thing here. And a lot of people actually don't even know about this. Kurt, you're absolutely right. Yes, some of you are writing down for me. Exactly. Use an indicator called ADX. Now, you might have gotten my video. I sent out a video if you've joined me on my website, leadingtrader.com, which is I like to use this indicator on beneath my chart, beneath the price. So on TradeStation, most charting packages will give you this, by the way, but on TradeStation, there's an indicator called Average Directional Index, ADX, which basically measures the strength of the stock or the market, okay? So you choose this, right? Put it under your chart, and as you can see, guys, this ADX yellow line that, okay, this measures the strength of the trend in a market. And as you can see, you got readings from 20, 25, 30, 35, 40, 45, okay? So what you want to do is draw a line across the 20 level, okay? Draw a line like this, across the 20 level line. If ever you see the ADX going below the 20 level line, that is a first initial signal to you that this market could be going into range bound or bouncing up and down, oscillating up and down, all right? You don't want to be trading in that kind of market, okay? You'll get chopped out. Notice that GS, Goldman Sachs stayed under this 20 level line. The ADX went under 20 and stayed under 20 for a considerable period of time. So that actually would have saved you a lot of money and a lot of pointless trading, okay, just by looking at this particular indicator here, okay? So what you want to see is ADX above the 20 level line, and for it to rise above it. And you ideally, by the way, ideally an ADX above 20, above 30 is the best one. All right. Have a look at this. This is the Dow Jones Industrial Average. This is the American markets, the U.S. markets. You can see that the market is trending really nicely here. See that? A series of higher lows, going higher. Look at the ADX trade going nicely higher, above 20 level here. In fact, it went to 40 level here. But look over here. Look, notice that in 2007, that the ADX went below the 20 level here. And notice what happened right there. As it went below 20, it's showing you that this trend is weakening here. And as we saw, it immediately plunged and started trending lower. The reason why you see the trend, the ADX going above 20 here, is because the trend started in the downward direction here. Okay? So I hope you got that and you understood that part. So how can we know if the market's trade is range bound? Use an ADX, average directional index, setting up 14. If ADX below 20 be a very choppy market, and just skip the trade or trade with lesser size with fewer shares. Okay? So that's what I would do. If you see ADX below 20, just skip trading altogether in that market. For increasing trend strength, looking for ADX above 20 and ideally above 30. Okay, I'm going to go now to the next level, looking at chart patterns. Okay, how are we doing, guys? Are you still with me? I'm going to ask you, are you all awake? How are we doing? You all awake? Good? Falling asleep? Okay, I hope not. We're still getting some good parts here. Good, good. I don't know how my UK guys doing over there. Right now I think we're what time is it here right now? Got 2:30. Okay, good. Making good progress, and we're almost getting there. Now, have a look at this pattern to see here, guys. So there are three major patterns. Well, it's four actually. There's a few more. But let me just go through the main ones here for you. These price patterns are known as reversal patterns, okay? Reversal patterns, which means when you see one of these patterns on a stock or a market, it shows to you that the market or the stock could very well be reversing its trend or its direction, okay? Let's have a look at an example. So just to make sure we're clear here, the ones I'm looking at here is double bottom, head and shoulders, and the cup. All right. By the way, this is also known as an inverse head and shoulders because a real head and shoulders would be the other way around. So this is sometimes known as an inverse head and shoulders. Okay. So let's have a look at an example. This is Krispy Kreme donuts. I don't know how many of you guys get Krispy Kreme where you are, but let me tell you, I used to wear slim fit shirts, for going out. So I was a slim fit guy, but now I cannot wear any of my slim fit shirts. In fact, I can tell you, I had some embarrassing situations where I wear my slim fit shirts and the bottoms would just pop out. Let me tell you who was responsible for this. Mr. Krispy Kreme here. About a year or so ago, I started eating a lot of Krispy Kreme donuts. I just basically got hooked on them. And I don't know if you like them or not, but I have stopped eating them, and I can tell you I cannot eat them anymore. But thanks to them, I'm now a couple of sizes higher than what I used to be. Anyway, what do you think here, guys? What particular pattern do you think we see on Krispy Kreme? What pattern is this? Is this a double bottom, head and shoulders, or double top? What do we think? This level here, that is the level you'd be going to buy at. So, in other words, when this W shape forms, I say buy, that is the confirmation. The confirmation for double bottom reversal is when it breaks essentially what you're looking for is a break of the middle part of W here, okay? So yes, you could find an entry point sooner, but that's the confirmation of it, okay? That stock went from $8 to $13 here, okay? 60% profit performance. What about this one here? What do you think, guys? What pattern do you think we see on Google in this period here? What do you think? Write me down your answer. What pattern is this? All right, let's continue then. That was indeed the Head and Shoulders, yeah. And of course, a break of the neckline here. A break. Sorry, the reason I just paused here because just double checking to see if everybody who might have. I don't know if I lost some audio here or not. Hoping I haven't. Okay, that wasn't the Head and Shoulders, and that's a break of the neckline. That's what we're looking for here. And it went from $500 to $620. All right, let's have a look at another example. Okay, this is one of the Hong Kong Hang Seng Index, and as we can see, what pattern do you think we see here? Anybody here tell me what pattern I'm looking at on this Hong Kong Hang Seng Index? Okay, what pattern is that? Yeah, it's a cup, absolutely, and all right, great. So that's a cup indeed. Just by the way, guys, make sure you write this down. Note this down. Something important I want to mention here. This cup and handle, all right, notice it forms two handles here. One is this handle part here, and one is this handle part here, okay? So one is a handle that forms at $600 or cents. I guess I'm looking at the Hong Kong index. And one is forming at 700, all right? Just to let you know, I favor the ones like this one, okay? I don't like the handle when it's below the previous high. Why? Because remember, this handle is below resistance. I want a handle which is above resistance. You see, like that, when it's broken through resistance, okay? So that's why, for me, if I ever see a cup and handle, I would rather pick this one rather than one that just formed something like this. All right, because that is essentially more bullish than one that's like this. Okay. Okay, let's continue and move on to the next example. Okay, 70% profit in 6 months. This is a double top. Okay, now double tops are one of my favorite examples, one of my favorite chart patterns. Let me show you a good example here. This is gold. Now you can see this rally here higher on gold, but have a look at the recent price action on gold. What pattern can you see right there at the top? What pattern is that? Yeah, it's a double top, right? So, in fact, I can tell you this. I was in a function. I was in a party or a function, you want to call it, a few months back, and I remember that the price of gold at that time was about $1,900. All right, and I told everybody, look, it's about time to short gold. Gold is going to come down to 1,600, and I tell you, a lot of people just didn't. I think they were just basically shocked about it. They said, "No way, gold is no way coming down to $1,600. What are you talking about?" But you see, that's the thing. Whenever people are getting very bullish on a stock or a commodity, that is also the time when you realize we've reached probably an extreme point, and you should really get worried when people around you are getting extremely excited or bullish about a particular market. Now that double top there was a very bearish signal, and as you can see, the market there just plunged and went to $1,600. Okay, I actually got short on this commodity right about there on gold at this level over here. By the way, if you're wondering why would gold be why is that a bearish signal? Why is that a bearish signal? The reason is that, remember, for a trend to continue, you want to see a series of higher lows and higher highs, okay? But look, this fails to make a higher high. See, all the way through here, gold is making higher highs, except here. This one fails to make a higher high, giving us first thing there's a weakening in the trend, there's a weakening in the price action here, okay? Right, let's continue. Another favorite pattern I quite like is called a triangle. And a triangle forms a bit like this, okay? So you see the market rallying higher and then just making a series of lower peaks like this, okay? So essentially what you see here is the triangular formation on the market. And the buy signal comes when you see a break through the top of the triangle, okay? Have a look at this. This was a silver triangle. Sorry, this is a triangle on silver last year, in fact. Now, where is the triangle? Well, let's draw it. That's the top line. That's the bottom line. All right? And you can see silver broke out of the top line of the triangle right there. Okay? And by the way, if you're wondering, well, did I make money on this? Look what I wrote to my blog. I actually posted on my blog, and you just read it here. And if you see up here, I said, look, silver is forming a triangular pattern. A break to the upside is a long signal. All right, so if it breaks to the upside, go long. All right, and what happened next? That's exactly what happened. We had the break from the top here, and silver went from $19 and rallied. Okay, it rallied to about $24.25. What happened next? Well, we know what happened next because the silver just continued to push higher and higher. It eventually went to $49 an ounce, as you can see right there. And of course, right now it's about in the $30 region here. We're talking about. Okay, pretty decent trade on that one. Okay, so we're going to come now to volume. Okay, just out of curiosity, do we have any questions on things discussed so far? Or is that all pretty clear so far, what we've been going through on patterns? Yeah, how are we doing so far? I'm going to discuss now volume. And volume is, of course, a pretty important part of our trading analysis. So any questions on that so far, guys? All right, so the important point about volume here is you always want to make sure that there is conviction behind the move. Okay, so really, when you're driving your car up a steep hill, you don't want to be driving with fumes. Okay, you don't want to be driving with an empty tank of gas. You want to be driving with a full tank of gas to see how much force, to see how much volume is behind that move. Okay, so in other words, when I look at volume under a chart, what I want to see is how much money is being committed to that particular market. All right, and the way I do it is, I'm hoping you've seen my videos on that so far on volume, but the way I look at it is, I put volume underneath my chart, and I use one with a moving average across it. So this is a volume indicator, or there's a volume under the charts with a moving average indicator running across it. That's the yellow line you see here. Okay, so what I want to see is I want to see these volume bars penetrating above the 50-day average. Okay, that's the 50-day moving average you see right there. Okay. Now you can see that during this part here, during this particular period, that Netflix, the stock we're looking at here, wasn't actually, there wasn't a huge amount of activity going on the volume here. There wasn't a lot of conviction behind this move. It's only here you can see volume bars pushing and penetrating above the moving average here. That shows that there is real conviction. There's basically the institutional money is being pushed in this market. Okay. By the way, in case you're looking at this, you're wondering what is the blue and the red. The blue is showing to you the days the markets went up, and the red is showing to you the days the markets went down. Okay. But what's important for you to understand is that when a stock is rallying higher, I want to see the volume confirming this by pushing and penetrating above the moving averages. And have a look at this. This is Netflix, predominant in the year 2010, and you'll see that there's a lot of volume pushing this market higher. Okay, there's a lot of money being committed, so the buyers are basically committing their money to this market. Okay, whereas if you look at over here, the volume really was much lower than it was over here. Okay, have a look at Netflix now, and you can see that this market has crashed. Pretty much the stock is plunging, and you can see that there's a lot of volume spikes here. Showing this particular stock is being dumped. There's a lot of selling on this particular stock right now. Okay, and yes, you can see this trend here is also reversed in a downward direction. So we had this nice trend higher, only to be broken to the downside at this point. Okay, so that's volume. Volume simply means the fuel that drives the market moves. It measures the distribution of shares or contracts amongst buyers and sellers. And an increasing volume indicates that buyers are more committed to their position, more conviction behind the buying. Okay, now we're going to look at momentum. All right. Now, by momentum, what I'm looking at here, what I mean by momentum, is imagine you're throwing a ball in the air. Okay, now you throw a ball in the air, look at the trajectory. As long as there is momentum in this ball you just thrown in the air, there's energy behind it, it's going to rise higher. until finally, as you can see, gravity acts on it, and it reverses and it goes down, right? You see that? Right. So what's going on here is that the ball loses momentum at this point, and it starts to go down. All right. So what goes on here, what is really happening here is that the ball simply just loses speed, and it falls. So here we can see it has positive momentum pushing it higher, and here it has negative. So the negative momentum pushing it lower. Okay. So let's have a look at a stock. This is Netflix. Okay. Now have a look at Netflix, and you can see that I have put underneath my chart this particular momentum indicator, which is basically called MACD or MACD. Settings are 20, 43, 1. All right, let's continue. All right. So what is going on here in Netflix? Have a look at this. Now, Netflix, in this example here, you'll notice that as the stock is going down, there is a huge temptation on a lot of people to think, well, this stock has reached the bottom, right? Reached the bottom, reached the bottom, reached the bottom. But I want to make sure you understand is we never buy stock when its momentum is negative. Notice the momentum here is positive, the momentum here is negative. Here it's above zero, here is below zero. That's why we've got a MACD here, settings at 20, 43, 1. Okay? So again, whenever this momentum indicator, which again, what does momentum mean? Momentum measures the speed and the force of a trend. When momentum goes below zero, as we're looking at this indicator, I would not touch a stock. I would not buy it. Okay? So let's have a look at an example. Here is another example. AIG, American International Group. You can see AIG was $850 it was in 2008. Where was the momentum? Was the momentum positive or negative? It was negative, right? Therefore, I'm not looking to buy this stock. Okay? I'm not looking to buy the stock or touch the stock. If anything, I'm going to short the stock. And look what happened next. The stock just plunged from about $1,200 all the way down to $24. Okay, you see that? Okay, and throughout this period, throughout this entire period, the momentum stayed negative. Can you see that? I mean, that's the, okay, let's go back here. Okay, oops. Okay, so that's the important point I want to mention. As long as the momentum stays negative, I am not looking to buy the stock or the market. Okay, and that would actually kept me safe. That would have kept you safe and also away from any danger of being caught out buying. I mean, imagine the amount of people who would have basically bought the stock at $800. They would have lost a lot of money there. So anyway, have a look at this. Is gold. You can see gold from 2009 onwards it went from below zero to above zero. So as a buy signal. In fact, you can see that was that showed to you that at that time that if the momentum is pushing higher, I'm not looking to short, but I'm looking to go long on gold. Okay, and it's still actually predominantly it's above zero at the moment. You can see here. Good. All right, and the way you do this is go on TradeStation. You put MACD indicator with 2043-1 setting, and I put it like this: 2043-1, or you can try 2043-9 if you want. And over here, I put the style as setting as histogram. So you put it at histogram, and essentially that's how I set it up on my chart. So momentum measures the speed and the force of a trend. Like imagining you throwing a ball in the air and lose momentum and comes back down. So an increasing momentum shows a stock is trending a higher speed, and a weakening momentum shows a weakening in the trend. Okay? All right, and use a MACD with 2043-1 setting or 2043-9 setting. Okay. Now look at some trading golden rules. Okay. All right, so some golden rules of trading. Number one, well, first of all, when you see an opportunity, take it. All right, it's very important. If you see an opportunity, take it. Don't just stand on the sidelines. And number two, cut your losses short. Okay, so it's important to understand that if you've made a mistake or if you've basically bought a stock and it's not going your way, there's no point of staying in it and losing money. All right. So let me show you an example of what an amateur investor would do. By the way, let me show you what I did many years ago in the year 2000. This is a big mistake that I made in the year 2000 when I lost money, which is when I bought that stock and it just basically went down and down and down and down lower. Whereas what I should have done is just basically cut my losses short and get out early as I can. All right, so unfortunately, that's what a lot of people do. They buy stocks and they buy all kinds of assets, and they watch it go to zero or basically plunge into. In other words, they just wait for the stock to go back up. And here's a question I want to ask you: what if you did wait? Let's say you did wait for a couple of years for your stock to come back up. I mean, you think waiting 2 years? I mean, is that going to make any difference? No, because you basically lost time. You basically lost 2 years of your time waiting for the stock to come back up. So really, you got to basically admit to yourself as early as possible that you made a wrong call on the stock and get out as quickly as you can. Okay, so let me show you an example of a stop loss order. In other words, to prevent this kind of things happening to us, go back here. How do we prevent the scenarios happening to us? We use stop loss orders. Okay, so stop loss orders can be extremely useful for us to determine where's the risk and also to control the risk so we don't lose all our money. So whenever we buy shares, we always put a stop loss order below where we buy. Okay, so if I buy here, I'm going to put a sell order below it. Okay, why? If the stock goes below, if the stock goes lower, it doesn't matter. I'm not going to lose. I won't lose everything. All right. So if I buy, for example, if I buy $90, I'm going to put a sell order, something like 85 or 80. So in other words, I'm not going to lose all my money. Okay, that's very important here. Now, when a stock goes up, I'm going to cancel a stop loss and move it up higher. By the way, a question I get sometimes from people is, you know, where do I put the stop loss? Where do I put it here or do I put it here? Well, the thing is, where you put the stop loss, where you put the sell order to protect yourself, depends on three things. Number one, depends on your strategy, depends on your, so it depends on your strategy, depends also on your what you see on a chart, and depends also on your stock as well. Okay, so there's at least two main things it depends on. So I would not use a standard default stop loss in every single strategy. Okay, so that's very important to understand. Yes, when a stock is going up, we cancel the sell order, move it up higher. As the stock goes higher, cancel the sell order, move it up higher. Okay, so again, the idea behind this is called a trailing stop loss. The idea is that you are limiting losses, but you're maximizing your profits. Okay, so you're keeping your losses small, but you're keeping your profits maximized. Okay, good. So how are we doing so far, guys? We come to almost to the end of this webinar. It is all going in. I'm hoping that you've understood and stop loss management. Okay, all good. Good so far. All right, brokers and charts. So the ones I would use is Options Express, which is $14.95. Then they've got MyTrack at $12. By the way, these are the commissions these charge. So Options Express and MyTrack are both quite user-friendly, and I have used them both in the past. So commissions for Options Express is about $14.95, and MyTrack is $12.95. All right, so in fact both of them are pretty good. But I'm going to show you the one I recommend to you here. Leadingtrader.com charting. I mean, if you go on this web link on my website, that will give you more information about the charting websites that I recommend to you. Well, but I personally would recommend to you use TradeStation. I mean, from my point of view, there's many advantages to using TradeStation as a charting software and a broker. Okay, because TradeStation is a combination of both a brokerage and a charting software provider. Okay, so they combine both. So, in other words, you get professional charts on the one hand, and you get to use their brokerage as well. Secondly, the commissions are as low as $1 per trade. Okay, so as opposed to paying $14.95 here on Options Express, and MyTrack paying $12.95, you actually save yourself a lot of money by paying $1 per trade. So, if you think about it, every time you buy and sell on a stock, every time you're buying and selling, you'll be paying about $30 here on these particular platforms or these particular websites. But with the broker like TradeStation, you're paying like $2 per trade. So you do save yourself pretty much a lot of money. Also, TradeStation has a pretty good customer service, like 24-hour customer service as well. More importantly, outside on TradeStation, is they don't trade against you. Okay, they do not trade against their clients. See, you may be aware of this, and I think a lot of people are not aware of this, that a lot of brokerages do trade against their clients, against the customer. So when you open an account, what they may do is start basically with the brokerages, they would trade against your position. And the reason why this is, again, don't forget, as I mentioned at the start, 90% of traders' money. So they know that the average person who's going to open an account with them probably won't last for very long. So they do make money from that as well. So TradeStation will not do this, by the way. They will not trade against you as a client. It's execution only as well. So what I recommend is write this down and contact them. This is the number you want to write down if you're in the U.S. or if you're outside the U.K. Basically, this is the number you want to use. So use this number 888-285-9768 or 954-652-7431. If you're in the UK, you can use this number 0808-234-1049, extension 7431. Okay, so that's 888-285-9768 for the US, 954-652-7431. And I recommend ask for a guy, Tony Ortiz. And here's the guy you want to talk to. Basically, I mean, Tony, he's actually one of the agents that I've known him for a couple of years, and he's really patient. I would say he's one of the nice guys, and you know, he's very willing to sit down and talk to you about all kinds of issues you want to talk about. So here's the guy you want to talk to, and I also recommend that. You email him, and you know, because these guys have deals going on at the time. Okay, the questions I get sometimes is, you know, what kind of deals do they have at the moment? Well, the best thing you can do is call them up yourself and find out from them. Okay, so contact Tony either from Tony@TradeStation.com or call him up on the phone numbers I've just given you right there. All right, and also if you wish, you can also tell them that you know me and see what else they can do for you. Okay. All right, good. So we've come now to the end of this webinar, and if you have any questions now for me, you can post them on my question box there. I'm going to answer you. And if you don't, that's fine. I'm going to wrap this webinar up, and I'll post a recording for you this week. Hopefully by tomorrow, you get a recording of this. But apart from that, I just want to thank everybody here for actually making the time to be here. I want to, first of all, thank you for making the time to be here. And I really hope that you've enjoyed it and you got a lot from this so far. So